All right, great. I think we are leveling out on our participants, so we're going to go ahead and get started here. Welcome, everyone, to our webinar on an analysis of equity liquidation after IPO in the life sciences area. My name is Kirsten Loita of Osage University Partners, aka OUP, and I'll be your moderator today. This webinar will look at the impact of selling shares of VC-backed therapeutic companies at different points in time, at lockup expiration, before data release, after data release, and some kind of holding period after IPO. For each of these different approaches in managing public stocks, we're going to examine a data set of therapeutic IPOs during a certain time period, and we'll go into that data set a little bit more later. So right now I'm going to have our OUP panelists introduce themselves. Anurag, do you want to start off?
Yeah, thanks, Kirsten. Hi, everyone. This is Anurag Agarwal. I'm a principal on the life science investment team here at OUP. Before OUP, I had a cell biology PhD from WashU in St. Louis, and then had spent a couple of years at healthcare strategy consulting at Boston Consulting Group before joining OUP in 2017.
Great. Thanks so much, Anurag. Bob. Bob? Yep, on mute, Bob.
There we go. First error. Bob Adelson. I am one of the co-founders and managing partners at Osage University Partners, focused more on the tech side. But I've been in the venture space for almost 30 years now and have invested across lots of asset classes and have a number of companies gone public over the years. And so it's a great topic. Look forward to discussing with you.
Great, thank you so much, Bob. Really looking forward to this webinar today. It's a little bit different from some of the other webinars we've run in the past. This particular webinar is going to include a deep dive on each of the following topics. Number one, analyzing the IPO market for therapeutic companies between 2010 and 2020. Two, key considerations when managing an equity position in public companies. And three, impact of liquidating public equity at different time points. And you'll notice the numbers associated with each of these topics. Those are going to be in the upper left-hand corner of the slides as we discuss each one of these topics. We're going to encourage you to ask questions throughout this webinar. If you would like to submit a question, please use the Q&A feature on your toolbar. You should see it down there, I think usually on the right-hand corner of your Zoom toolbox. We really like questions, so please send them our way. To start off, we're actually going to ask you a question. We're going to poll our audience on your own equity liquidation practices. So you should see a poll box appearing in your box right now. So if you can let us know, is your equity liquidation policy to sell as soon as possible after the lockup expires, 6 months after lockup expires? When our equity managers decide to do so, they may have some sort of practice they use, or is there some kind of other practice that is in place? And as we allow that poll to continue going on, we're going to go on to our next slide just to let you know where to find this presentation. Once we're done here today, there's going to be a recording of it on our portal, which is available to our tech transfer folks. And it's also going to be on our YouTube channel. And there's some instructions here about how you can find it on our portal. We're happy to help you with that as well in order to get both the slide deck as well as a recording of this webinar. So next slide before we go to our poll results is a disclaimer. We do want to make sure that we have a disclaimer in here. The content of this webinar is an analysis that we have done. We're not financial advisors. Please don't take this as financial advice, this information. So this is just an analysis we did, and then we're relaying that information to you. So we're going to end the poll here. Thank you so much for those of you who responded to it. We're going to share these results. So all of you can see here the results, but 39% of you say that you liquidate as soon as possible after the lockup expires. Another, actually very close behind that, is when our equity managers decide to do so. And then a few have other kind of practices, or 6 months after the lockup expires. So interesting, definitely a variety of practices at the institutions that we work with. So we will now move on to the data itself. I think actually, Bob, you're going to be taking this over now and talking about the data set we analyzed.
Yes, I'm just going to pause on this slide just a moment. First, we're only going to talk today about therapeutic companies that have gone public in the last 10 years. And a lot of the data comes from PitchBook. There's some more nuanced information and how we're using it out of the data set that Anurag will address while he speaks. But for now, I think that's a good quick look at the data set. New slide, please. Natasha, new slide. Thanks. So this is a quick snapshot of IPO activity in therapeutics companies since 2010. The line is the median amount raised, and the pillars are the number of IPOs during each of the covered years. As you can see, the last few years we've enjoyed a really wide open IPO market. If you widen that aperture and look back over the past 20 years or so, you would see kind of longer cyclical patterns, a period of a lot of activity in the mid to late 90s, capped off by a really huge year 2000, and then a long arid desert that really didn't end until 2013, around 2001 to 2013, where there were 5 years where there were an average of only 3 IPOs. So the window really slammed shut. And one of the things that we want to keep in mind is that the window opens and closes somewhat mysteriously. It always makes sense after the fact, but it's very difficult to predict when the window is going to close. And that is going to have a real impact on how companies are currently being funded, as we'll see in the next slide, Natasha. And in this slide, I'm sorry.
Bob, I apologize. I actually, and maybe you already talked about this in the previous slide, but the dip in 2016 to the surge in 2017, was there something in particular that happened there?
Well, not before the fact. After the fact, I think we point to a few things. The window partially closed, I think, in anticipation of the election and major questions around what was going to happen around therapeutic pricing. And so that the overall market was a little bit more iffy in the therapeutic market in particular. And then after the election, there was more certainty on those areas. You see a bit of a snapback, partially because companies that deferred going public in 2006 went into the window. And then you can see it really picks up in 2018 and 19.
Great, thank you so much.
Thanks, Kirsten. This chart takes a look at the pre-money valuations at the IPO and the capital raised before the IPO. So the green line is capital raised, the red line is the median IPO valuation. Anurag is going to deconstruct the meaning and the importance of the gap between those lines as he goes through some slides after I finish up here. But there are some key takeaways from this slide. After a period of relatively flat amounts being raised pre-money, you can see through kind of 2016 or so, even as IPO valuations were increasing, now in the last 3 or 4 years, the amount of dollars going in before the IPO has begun to scale, and meaningfully scale. And this is happening even though companies are going public earlier and earlier, somewhat displacing what would have been pre-IPO rounds. So I think there are a few reasons for this. The first and foremost is that VCs are being paid to do it. That although the dollars going in has increased, the valuations at the IPO have increased more sharply still. So we're getting paid to put more money to work. Also, you're seeing a lot more companies getting founded with a view from the very beginning that they're going to become public candidates. And this means that their ambitions from the first dollar are large. They support more therapeutic programs at greater expense. They staff up with officers, including general counsels and CFOs that have public company experience. And all of that means larger raises and larger spends. So these more ambitious companies are being supported by some very large Series A rounds, which tend to be tranched over time. There may not even be a Series B round. They might go right to a crossover. Perhaps there's a B round. And those companies are really tailored for IPO within kind of a 3-year period or so from the Series A round. These are the companies actually most vulnerable when the IPO window closes, because it's much easier to scale up your spend and your ambition than it is to scale it down. And these companies are burning through a lot of money, and if they can't raise it in the public markets, the private markets will be challenged to come up with sufficient capital to support them. So one of the key questions is one that Anurag is going to take on now, and that is this increase in IPO activity good news for us and for our university partners, or is it more equivocal? So Anurag, you want to carry it forward from here?
Yeah, thanks, Bob. So again, as I think as Bob had mentioned, the IPO market for therapeutics is quite robust. And what we'll do on the next slide is try to look if this robustness in the market has similarly generated value in these companies. So, you know, if you raise more money and your pre-money is higher, is it entirely because you have raised more money? Or is it that you have also created significantly more value in the company that is not just the capital invested? So here I've tried to define how we kind of define the value creation in numerical terms. So if you look at the pre-IPO stage, the value creation is really defined as the pre-money at IPO, subtracting the sum of all the capital raised pre-IPO divided by the total capital raised. So it gives you so if you have created if you have a $2 pre-money and $1 raised, you have created a value of $1, which is going to be 1x of your capital invested. So that's how to think about pre-IPO. And in the post-IPO setting, the value creation is primarily, we are tracking it by share price. And so you're seeing the relative increase or the proportional increase in the share price for any company. So if the share price doubles, the value here would be 1 as a value created, which is the additional value outside the original invested capital. So if you go to the next slide and see how does this value creation tracks over time compared to the graph that Bob had just walked us through. So in this is similar to the graph that you guys had previously seen, except that there is a black line that has been added, and this tracks to the secondary axis on the right side, and which is measuring what is the value created pre-IPO. And what you'll see is the IPO market really started opening since 2013, and the value creation till 2016 has relatively stayed flat, even though there has been a slight increase in the pre-money valuation. But as you see, with a dramatic increase in the pre-money valuation in 2017, the value creation almost doubles pre-IPO, and therefore these dollars have created much more value in these companies before they're going public. However, because the trend on the capital raise from 2017 to 19 have dramatically increased, while the pre-money valuations have not kept up with the amount of capital raised, the value creation before IPO has shrunk. And this goes back to Bob's comment that the companies are going public earlier, and therefore you have lesser chance to create value from the capital that you have raised. And so maybe the companies are more betting on creating that value after the IPO, when their banks are full of cash with significant raises both before IPO and during the IPO. And so I think, and that will really tie well with our later analysis of how do you think about liquidating your assets when the most of the value created by these companies may be shifting after the IPO. And therefore that becomes even more a critical question nowadays, which we will discuss at the later part of the presentation. So this graph has defined the median, and if we go to the next slide, what we want to see is, does this hold true for the top 25% of the companies as well? And so if you look at the top quartile for each of these lines that we discussed, what is noticeable here is, if you look at the black line, which again defines the value created by these top quartile companies, from 2012 to 2015, you're seeing a dramatic increase in the value created by these, which was compared to the median, it was pretty flat in those times. And therefore you're seeing that in that time period, we're seeing big separation from the median of this cohort to the top really high performing top quartile companies there. However, if you look at 2017 to 19, like the median, the shrink in the value created by even the top quartile company is similarly dramatic. And so these companies, because of going public earlier, are still not able to create that value. And therefore, again, even for the best performing companies in a way, the value creation is slowly shifting to after the IPO. And therefore, the value after the IPO is a key driver for return on investments for private investors. But I think, so that kind of just describes of how the pre-money, the capital raise impacts what returns you can get. And I think as we go to the next slide, we will talk more about, if, a couple of other things that we have noticed in these cohort of companies. So, you've heard, yes, Kirsten.
I apologize. We have a question, and so I was going to ask it. Is this a good time?
Absolutely.
Okay, so the question was, is the pre-money valuation arbitrary? Is there really an accepted quantitative method for establishing pre-money valuation?
That's a great question. And so there is science and art to it. So the science part of it is, what is the commercial opportunity here? And, how can you, what is their discounted cash flow look like? And you can come to a certain pre-money valuation. I would say that contributes 25% to the question, and I'll also look at Bob to give his perspective on the longer term horizon, because I've only seen it in a few years recently. And the 75% of it is art, which is primarily based by two or three things. One is how much money you have raised and where your pre-money already exists, or the post-money after your private rounds exist. And second is, the crossover rounds are going to look for some return as soon as you go public, which gets shifted from 20%, increase to 30% to 40%. And so sometimes you almost back calculate that the right IPO price to get interest in a company is, let's say, 500 to 600 million. And then you kind of back calculate to say, what should be a crossover round? And so defines your IPO pre-money round, which is a little bit more the art of the industry here. Bob?
Yeah, I think arbitrary might be a little bit harsh. A company that has a market potential of $1 billion is going to be priced differently than one that has a market potential of $5 billion, and obviously risk adjusted. So when you pull back far enough, the venture investors have a certain fairly consistent hurdle rates. They apply, a sense of how much risk does the particular company, technology team present, and more importantly, what's the TAM? What's the total addressable market? If you get close enough, everything seems arbitrary, right? Whether it's 30 million or 35 million is just a function of negotiation and how much competition there is. So I would say it's directionally non-arbitrary, but kind of specifically, it's more kind of the dynamic of the moment. The way that actually comes up from our perspective is, at what point, speaking of arbitrary, at what point is the valuation too high? And there, the line is clearly arbitrary. When we decide $80 million is too high, but 70 wasn't, it's hard to argue that wasn't an arbitrary line, but you have to draw the line somewhere, and it's grounded in the principles which I described.
Great, thank you both. We have one other question, but I'm going to wait on this question because it takes us back a little bit, and I don't want to interrupt your flow too much at this point, Anurag.
No, not a problem, Kirsten. So this is the last slide of describing what does the analyzing the IPO market in general, and then we'll get to the second and the third point. And just you've kept hearing Bob and myself mention that the companies are going public earlier, and we wanted to kind of look at the data and see what does that really mean. And here what you see is what we have plotted is the median and the top quartile. Median is in red and the top quartile is in green, is the number of years taken by these companies to go public from the year they were founded based on PitchBook data. And what is interesting to see is, yes, since the IPO market has opened in 2013, let's say, the top quartile has significantly declined by 2015 and then relatively stayed constant. So that means the really good performing companies, if you think, they have gone public earlier, they have been supported by the markets. However, the trend on the median is even more interesting to me, is that you have seen a decline from 2013 to 2019, and that has been consistent. There has been no flattening out in the later years as you see in the top quartile. And what does that mean is, though the best performing companies are also getting out in front, or let's say the fastest moving companies, and that has stayed stable, as a cohort, the entire cohort of therapeutic companies is also moving earlier in the IPO market. And that just shows the robustness, the appetite of the public investors in taking these larger and larger number of therapeutic companies that are going public. And so this is something that intuitively we all kind of think about in the last few years. I think the data really kind of makes you understand that how broadly it is being applicable in the therapeutics market. So I think that after that, so you know, that's our overall analysis of the IPO market, and I think now we're going to shift our focus a little bit, thinking about how to manage equity and what is the impact of liquidating at different places. And I think Bob's going to take the first part of it, and then we'll go into more analysis at a later point. Bob?
Kirsten, you look like you're ready to ask the question.
Well, yes, well, and I think actually the question may be answered on the next slide. So I thought, Bob, I would let you go into the next slide.
I can see you leaning in. You had your body language was ready to go.
I'll ask the question, but and you can delay it based on the coming slides. But the question is, the IPO seen as a way to raise money that rather than an exit?
Yes. So great question, and we do address it in the slide a bit. So let's just start with, on the topic of how you manage your public equity, what's the norm? And then, because we're really going to be mostly talking about the departure, how things are a little bit different now. So the norm in the venture community, for a long time has been to lean towards liquidating your position when a lockup expires. Now I'm talking about not just therapeutics, but across all technologies. And that's because the IPO has usually been in the company for several years, and it's meant to be a liquidity event. And typically you don't really have any informational advantage over the rest of the market. And so in an orderly manner, you would sell your position when the lockup expired. There are problems for a venture firm holding long-term in terms of misalignment with our investors. Our investors, of course, have put a lot of money with other managers which are specifically tasked with investing in public companies, and sometimes tasked specifically with investing in public biotech companies. They don't look to us to be managers of public shares. And over time, we run into a problem of kind of what we call the free option misalignment problem. This is particular for firms that are struggling to become profitable. And as you probably know, the way that we get paid on our side is by taking a share of the profit of the overall fund. If we're not yet in profit, then the cost of us having a public loss could be zero because we were never going to be in profit. And so we might prefer to hold a $5 stock with a hope, even if it's a poorly conceived hope, that it would get to 50 and get us into profit, then sell it. And our investors are concerned that we begin to invest for our best interest and not for their best interest if we hold public stock for too long. There are challenges, particularly on the life science side, which is that biotech IPOs specifically are not exit events, but they're a funding mechanism in lieu of what used to be a Series C or a Series D round. And more to the point, the IPO valuation, which Anurag has kind of demonstrated.
I don't have an answer for that.
Oops,
is there
sorry.
something else I can help with?
Sorry, my Siri seems to think I'm talking to her. The IPO valuation is just not sufficient to drive a VC-like return. It might be a 2x or a 3x. We need our best companies, which are typically our IPO companies, to drive a 5 to 10x outcome. And of course, because they're going public early, clinical data that is really material to our outcome could be several quarters post-lockup. So it puts us in the position of needing to hold for a much longer period of time and having to have a strategy for doing so. I would note that venture firms oftentimes are still sitting on the public company boards, which creates regulatory restrictions on their ability to sell as well, although it has a little bit less of effect on OUP, as I'll talk about in a moment. Next slide. So in terms of how we approach public equity, a few points. So we tend to have a relatively small piece of the company, which means that we can sell a little more easily. We don't have daily volume restrictions quite as meaningful as a really large holder would. We're rarely on the board, so we don't have regulatory restrictions. So we have more flexibility than a typical venture firm would. And finally, our investors, our institutional investors, would prefer us to sell rather than to distribute shares, which I should have said, I apologize in the last slide, that the default for venture funds is either to sell or to distribute shares when the lockup expires. So for us, what we want to do is have a more of a standardized practice, have consistency company to company. So we do as follows. First, at the very time that we first make the investment and do the original underwriting, we define the inflection point. What is the value creating point? And we also define what's the company's value at that time. We do our best to determine what's the terminal value of the company if our core scientific bet is positive. And we memorialize that. And then our core view is we should hold the public positions until that investment thesis and that key inflection point has been played out and the data card has been turned over. So once the company is public, we will have set a valuation target on a per share price basis, and we will hold until the data card is achieved, or sometimes the price runs up before the data has turned up. The market oftentimes gets irrationally exuberant, and if that's the case, we'll sell all or some of the position before the data card is becomes apparent. And then we also try to reset our valuation goals roughly every 6 months or so, because there's new data that we want to take into consideration. We look at our public positions every week at the team meeting, and we do a deep dive on those companies periodically, usually a couple times a year, to update valuation goals and our overall thinking. So we're not as active as a company that was just holding public stocks, but we do put time into managing our public positions. Next slide. Thanks. A few other points about how we and other VCs think about managing public equity. First, we don't have trading strategies. We're not momentum players. We're not trying to catch a run up. We're trying to be clever in how we exit. The one way in which we do think about market timing is when the market collapses, then we will typically not sell. We'll wait for the market to return to kind of normal levels before we exit, even after our initial thesis has played out. That's first. The second is a lot of times in the therapeutic space, our original thesis is not even the key driver of company value anymore. It might be a secondary program or a program that was underwritten since the company went public. I think one of the linchpins of us holding our public stock is we think we have an informational advantage. And when we don't, if we don't have any special knowledge, deep knowledge about the play, if it is entirely opportunities that happen since our deep underwriting, then we don't have any argument for holding the shares, and we sell. And finally, there's a small subset of companies which don't really turn at all on a data card turning. And that might be, for example, if we're making, or our thesis is this is a great management team, they're going to generate lots of opportunities. We don't care whether the first one works or not. It's just kind of representative of their skills. And there we might have a totally different set of drivers that help us decide how long we want to hold and how much time do we want to give this management team through business development or through other relationships to create surprising value. We try to define that right up front. We don't want to decide midway through our holding that it's all about the management team and not about the technology, because the slippery slope is you always find an excuse to hold on for a better price. We try to be very disciplined and define our criteria and our thesis up front. And slide. And then before Anurag kind of digs into what the data tells us about different ways to consider liquidating your public positions, I thought we would just kind of categorize the options that one thinks about. And we think about it just in two very broad baskets. One, those that are rule-based, and one, those that require active management. That's a pretty bright line. They kind of bleed into each other. But on the rule-based front, the most obvious one and the historic one is just to sell when the lockup expires. It has the advantage of providing earlier liquidity. It doesn't require active management. It has the disadvantage that you miss out on outsized returns. We did a little back testing around this at OUP1. There's not really enough data to drive a lot of conclusions, but we did look at OUP1 and said, what if we compare what we did, which is sell everything at lockup, which our LPs have asked us to in the first fund, to holding everything for 5 years? And the answer was, there was no real difference. We had a huge winner that we could have ridden, but we had other companies that we sold that ended up not doing well when their data cards were turned over. So in any event, the one approach is just sell at the lockup, easy to oversee. The second approach, also rule-based, is just set another time period. Say I'm going to hold everything for 2 or 3 years, just a set time period. That gives enough time for the data card to be turned, for an M&A opportunity to emerge, and doesn't require really active management either, which is its advantage. You lose the earlier liquidity, you catch the opportunity of outsized return, but you also expose yourself to to bad outcomes. And then where we're looking at more active management, you can sell just before the key data is turned or just after. And what we've seen is prices do run up in expectation of the seminal data being disclosed. And if you sell early, you capture a fair amount of the upside without capturing the downside, which is that sometimes the data are not good. And generally speaking, not good means not good data means everything from average data to poor data. You need positive data to drive a good price movement. And the disadvantage of selling before the data card is you still left some value on the table. The stock can still run up. And now you have to pay attention. You need to actively manage. You have to know when the data is coming out. You have to watch the trading activities and the run up in advance. And similarly, you can sell soon after the data is revealed. This is closer to what you see in among the VC communities. That allows you to capture the best performing investments, but you've exposed yourself to loss, and it requires more active management. And some of the decision about what you want to do has to do with, are you more opportunity driven? You lose sleep because you left a 10x on the table, or are you risk driven? You lose sleep because you held on to a company which traded up to something unremarkable and then traded all the way down to nothing. So, the next few slides, we're trying to dig into what have we learned about the timing of what can you drive looking at the data about how to go somewhere in between actively managing and totally rule-based to try and be kind of intelligent managers that live within parameters. And Anurag's done some really interesting work around that he's going to now take you through. Anurag?
Yeah, thanks, Bob. Actually, Natasha, can we go to the previous slide? So before we dive into the data, I wanted to clarify a few assumptions in the analysis that will help everybody orient themselves when they look at the data. So lockup expiration is usually, for those who are not aware, is defined as 180 days post the IPO date. And any investors pre-IPO, they are not allowed to trade out of those shares for the 180 days. And so for universities and for private investors like VCs, the first opportunity of trading out your share comes after lockup expiration, and therefore it is the first time point. And it seems universities majority of them tend to focus on that date as a way to liquidate. Just before the data, it could mean anywhere from lockup to whenever the clinical data release is. What we are defining here is kind of shortening the time frame, and we are saying right before the data. So as Bob mentioned, sometimes the stocks run up on price, and so you may be able to capture some of that upside without exposing the downside risk. So what we look at is an volume weighted average price for 30 days before the key data release. And similarly, for right after the data, we look at volume weighted average price for 30 days after the data release, so that this volume weighted average price truly defines what will be a price for trading out of any security, rather than looking at a price on any single day, which may have a lot of noise in terms of what is your ability to liquidate on that day. So just a couple of terminology definitions before we get into the data so everybody can orient themselves. And please feel free to post any questions you may have on any terminologies that we address and are not clear. Natasha, if you go to the next slide. So, as Bob mentioned, there is an inherent understanding that yes, waiting for data should drive higher returns because the companies become more valuable. All therapeutics companies are driving towards some clinical data. So what we looked at is look at these 323 therapeutics companies and look for what was the median or average return, the value creation that we talked about earlier, which is the difference in the stock price from IPO date divided by the stock price at the IPO date. And what you see surprisingly is that the median and average are not that different for these three time periods. And in a way, but as with the time risk that you take by holding a stock, you're adding risk to it, but it's not paying out in any significant way by taking that risk on. So the question, after looking at this data, we asked is it really worth holding on to these stocks for a longer time if on an average, if I consistently play the thesis across our portfolio, we're not going to make that much more money if we wait for data. However, if you double click on this data and if you go to the next slide, what we are trying to do is, we are trying to look at these companies and say, what is the proportion of the companies and what returns they are giving? So if you look at the graph on the right side that we just came on the screen, the y-axis is defining what percent of the 323 companies are giving you a certain value creation, which is either greater than 2x, greater than 4x, or greater than 8x. And what you see is if you're looking for a modest return of 2x, which will usually not deliver the VC-like returns on their portfolio, you get about 2x, and the proportion of the companies that can deliver you does not significantly change over these three time points. But the interesting data comes when you look at the more outlier returning companies, the returning companies of 4 and 8x of the capital invested value. Now you're seeing that at lockup, only 9% of the 323 companies had more than 4x value created. But if you wait for data, your probability jumps 2x and becomes 18% of that 323 companies. Now, if you're looking for really the biggest winners, only 1% at lockup will be able to give you that versus 6% after data. And so what really is happening here, this data suggests that if you wait for data, what you're doing is you're really driving or increasing your probability of identifying that winner. Now, these will be rare events, as we are seeing. Even after data, only 6% of this entire cohort is going to deliver that. But as Bob had mentioned, VCs are playing the game of these really big winners, and you do everything to increase your probability of identifying one or two of those in your portfolio. And the one way to do that is to really wait for the companies that after the data, because you will almost the 2 to 6 times higher probability of identifying that outlier winner. So if we go to the next slide, we have talked about in the previous slide the value created overall, which is from the formation to the day of the data release. But if you look at universities and even VCs, the real decision is not about the value created before IPO. What is the value created after the IPO, and does that look any different? And so again, on the left-hand side, when we look at the median and average, it does not look that different between these 3 data points. But as previous slide, if we double click on those and look at what is the return and what fraction of those companies return what share price increases after IPO, you start seeing the same thing, that if your share price is going 3x of your IPO price, you have 4% of companies at lockup versus 12% of the companies at after data. And so you have increased your probability 3x there, versus if you are looking at 4x increase in price, you again are increasing your probability from 3% to 9%, which is 3x. So again, suggesting that if you're looking for that outlier winner, the way to increase the chances that one of your companies would be able to deliver that is to wait for data. And that is when these 3 time points start being different. One question that we looked at and said, is it worth waiting for data, or should we sell right before the data? And that is a question we have struggled with internally as well. And if you look, again, at 3x price, you don't see much of a difference between before and after. The separation really starts happening for these really outlier winners. But the other consideration also sometimes of VCs is because of their bigger positions, the volume of trading before the data is not as significant as after the data. So the window of liquidating there is also limited. And so, people can take a hybrid approach of sometimes of taking some capital off the table if the market has run up to the data point, and then keep some capital on the table to get the further upside. But I think that is another point of more discussion, is whether what happens before and right after the data, and when should that decision be made. So this is just, we've looked at how the proportion of the companies that we have created makes an impact on finding an outlier winner. If you go to the next slide, what we have tried to say is, okay, we agree that there will be a higher probability if you look at the entire cohort, but our key decision point starts when we are at lockup, because that's the first time I can liquidate my position. Is there any sign at that point which can further increase my probability? And so in a very simple way, what we try to do, and it's represented in this table, is if you look at the left-hand side of the table, we are dividing companies in 2 categories, whether their price at lockup is higher than the IPO price or no. And if you'll see, only 43 companies are really higher than at the lockup price is higher than the IPO price, while majority of them is lower or equal. So if you kind of divide those 2 companies and then say, okay, of the 43 companies that actually had the price higher than the IPO at lockup, what does that mean? Does that give any indication of how will they do after the data or before the data? And I think the data is very intriguing here, that of those 43 companies, almost 70% of them keep their price above IPO at lockup after the data, and about 50 or 60% of them keep that before the data as well. So again, if you go from before the data to after the data, you increase that 10% chance of it. I think the reverse is even more telling, that if your lockup price is below the IPO price, 80% of the time, so approximately, the price will stay below the IPO price. And therefore, one can start thinking about whether a price at the lockup is some indication that, whether the price will stay above the IPO price or will below. And so one way to look at it here, which we have put in the key takeaways, is if your IPO price is, if your lockup price is below the IPO price, maybe it's an indication to sell. But if your if your lockup price is above the IPO price, maybe it's an indication to hold on for data, because the chances of it going completely south are significantly reduced. So this is just comparing it to the IPO price. It does not look at what returns can you make. So if you go at the next slide, what we have tried to look at is the probability of outsized return also different in these two cohorts. So in the green in the left-hand side, if you look at those 43 companies that have lockup price is greater than IPO, and in the blue shaded part of the graph, we are showing for the 280 companies that have lockup prices below the IPO price. And on the y-axis, what we are really plotting is what % of those companies are giving us that return. So what is interesting to see again is, if you want the 3x or the 5x of your IPO price, your probability of that significantly increases in this cohort of 43 companies compared to that in the cohort of the 280 companies when the lockup price is below the IPO price. And this again speaks to the fact that if you kind of hold that 43 companies, you have an even higher probability of driving that outsized return compared to having a probability of getting that outsized return if the lockup price is below the IPO price. And if you look at the numbers in red here, your probability increases about 5x for a 3x return on the IPO price, and almost a 6x probability if you're looking at 5x or more from the IPO price. So I think the previous slide combined with this slide is making us think whether the lockup price is a great indicator of what is future to come. This is not to say that, like, if the lockup price is higher, it will never go down. You just have a higher probability in a cohort to have a further increase. But the companies both whose lockup price are higher than IPO can have negative data and they will decline, versus the companies that have it lower at a lockup will have significantly positive data and they will rise above. So it can be a way to increase your probability, but does not change the risk in terms of for any specific company whether it can go up or down. So I think this was a surprising finding for us, and that is something that we are trying to unpack internally for as well, and think of what weight can we give to our decision at lockup.
Yes. We have a question. May I interrupt you now, or is there one more?
No, please. I think we're going to summarize after this, which I'll hand over to Bob to summarize the entire takeaways from our presentations. It's a good time.
But this is a really, really good question. It was one that was kind of running through my mind throughout this as well, is that in the case of a therapeutics company with several different compound or clinical trials or in the pipeline, would you consider the release of data to be the first clinical trial release? Or, I know that for us, we usually have a certain data point in particular that that we've invested towards. What are you talking about here when you consider release of data?
Yeah, that's a great point. And, there's a terminology in the public markets called bait and switch, which we can talk about a little bit more. But in this analysis that we have performed, we have looked at the first release of news that is significant. So usually that is from the lead compound or the lead asset. And therefore, what we are trying to say is, from the day of the lockup, when do you see the first real change in volume that will signify a significant news information from the company, which is usually the clinical data, and we are analyzing that time point. What I meant by bait and go ahead, Kirsten.
No, please go ahead.
What I meant by bait and switch is sometimes some companies will have failure on their first product, and the price will be quite suppressed for a long time. And then in their pipeline, they have pivoted their company and a more valuable asset starts coming up. And as that news is released to the public markets, the stock starts taking a U-turn and starts going up. And there are many examples of companies which have done this and very successfully driven very large returns. However, the challenge for the investors are they don't know if that is happening if you don't have insider information. And that is why a lot of regulatory restrictions are put for people who are insiders. And second is your period, the length of period you have to hold can be outside your time horizon. So those are the only comments that I can make. Bob, please feel free to add, and the next slide is yours too. So
I have nothing to add. It was a great answer. I just want to kind of reflect for a moment before we summarize on how surprising and maybe troubling, maybe not, these data are. So almost all these companies, between the IPO and the lockup, there's been no new information in the public markets. No data have been revealed. It would be unusual for an M&A event. This is stock movement during the first 6 months post-IPO based on no information at all. And it's not as if insider information could leak out, because no one knows what the data are anyway. They're all blinded. So one of the things that we want to explore is, what's the signal here? Why is it that the market seems to be surprisingly predictive at lockup about the ultimate fate of the companies? And it could be because the companies are thinly traded, a very small amount of almost sentiment analysis reaching the market and moving the stock just a little bit. So just a first observation, it's a really interesting finding that is not obviously explainable. The second, of course, is if you can identify at the lockup which companies are going to be very valuable, even though no data has been expired, are there any signals that should tell us what companies we should invest in at the A round? How much of what is appearing late in the company's life is informative of what we can do when we invest? So there's a lot of really interesting stuff to unpack here that really are just now beginning to think about. So we can probably advance a slide, if there is a slide to advance to, in terms of our overall takeaways. So I'm not going to read through these. You guys can look at those. Just want to make a couple of broader comments. So whether we like it or not, we're now all stuck in being in the business of managing public stocks and public shares. And I think the VC community on the life science side is trying to get smarter, and we'll have to continue to get smarter as long as we have fairly large portfolios of public companies. I would say that it's very important, whether you're modified rule-based or choose more active approach, to set meaningful guardrails on your process and on your thinking, and to adopt a very consistent approach. The psychology of public stock investing, very unfamiliar to us, leans very heavily towards all kinds of biases in your thinking, both loss aversion or insisting on holding everything well past the date when you should. And the way that we've tried to wrestle that to the ground is to be extremely explicit in our investment memos and all of our conversations afterwards about specifically what our goals and expectations are, and to hold ourselves to those goals and expectations. And I encourage our partners, whatever approach they take, to be consistent and to articulate them and to be as consistent as possible. And then as we learn more about the space, continue to study it, we would be happy to come back and share more insights. This is still really an emerging phenomenon for us as well. Anurag or Kirsten, anything else you'd like to add?
No, I think that was all.
There was nothing else I have to add. I would like to thank both of you. We're actually going to ask people to answer a survey. Of course, we always ask people to answer a survey for us on the value of this particular webinar to them. There should be something appearing in your chat box shortly with the survey. Also, when you leave the meeting, I think that survey will pop up for you. So if you could answer this survey, we'd very much appreciate it. Natasha, if you can put that in the chat box there. Bob and Anurag, thank you so much for this. Anurag, thank you for putting this analysis together. Very interesting. I imagine we'll have a number of follow-up questions on it. And we appreciate your time today. Thank you to our audience so much for joining us today for yet another one of these webinars. We really appreciate your joining us, and also for all your suggestions for these webinars. We could not put on these webinars without these terrific suggestions that you have all the time. And a lot of the suggestions that you provide are things that become webinars for us. So Bob and Anurag, thank you again for your time today. And thank you to our audience for joining us.
Thanks, Kirsten.
Thank you, everyone.
Thank you. Bye.